We're gonna get started.
And the green
Welcome back, guys. If you're new here, thank you for coming. We have some quick programming things to get through. So if you're new here, we do a lot of programming things like provide as much transparency as possible for you guys and tell you guys what we've been doing for the past week. In our analyst program, we have two groups of students who are paired up with two startups from UF Innovate. And this past week, they've actually met up with founders of both companies. And they've also submitted deliverables, so some cool stuff going on there. This week, we've really been kicking into high gear for VCIC. This is our flagship event, and it's going to be happening next semester. We're actually hosting the competition and competing. We're going to give you guys some more details about that in a second. And yeah, in terms of us, we had a really fantastic meeting yesterday, really good turnout. We had an IP attorney, Brian Wilson, from South Florida, talk to us about IP and startups. Really cool event. We're going to get the slides, and we should be sending those slides in the newsletter if you guys are interested in that. And our generalist program, quick update. If you're a generalist and you're here today, we have an extra lecture that we're going to be teaching you guys today, and some more updates. So please try to stay after. If you have to go though, just whatever, it's fine. Just shoot us a text after where they get to go. But yeah. And as you guys can see, again, this is just some more transparency. We've done a lot this semester. The panel event, if you guys can go. If you didn't go, the recording's online. The flip event, we didn't record it, but it was yesterday. And yeah, this is just the backlog. So some quick stuff on VCIC.
Yeah, so as Darryl mentioned, we're both competing and hosting VCIC. So just some details on the competition end. We're going to have 6 students from the Warrington Ventures going over to American University in DC. And yeah, we're going to be doing a pretty strict training regimen, doing a couple of mock runs. So if you're interested in learning more about like what the training process is for VCIC and what that would look like in preparation for next year's VCIC, feel free to reach out to us if you want to learn more about how that process is. And it's pretty meticulous, and the actual competition itself is extremely unique, unlike any other case competition. So yeah, just excited for that. That'll be happening February 3rd.
Yeah, if you guys want to learn more about the competition, it's vcic.org, hosted by UNC Chapel. Cool. So current event.
So this is a new company called REDDY. It was founded this year. There's 3 employees. So they're a developer for, they help teach people sales. So they help with the onboarding process with new companies that are looking to improve their sales team. So they're a SaaS company. So they sell their software. And this is, again, supposed to help with the onboarding process for new salespeople coming out of college, kind of entry level. Help them learn how to do sales properly. So what key metrics would you use to evaluate this company if you're looking as a VC fund to invest in? So what type of, like their revenue, just like different ways you look at their revenue, their customers, how many new customers they're bringing on each month. Like what do you think that most important metric would be for this type of company? Or their growth? Just anybody have any ideas for that, and what they think the most important one would be, or what they would value the highest?
I think LTV to CAC would be a pretty popular one, which is the company's lifetime value divided by their customer acquisition cost.
I mean, that sounds like an awesome one to me. It's not one that I did research.
Real quick, how many of you guys have heard of SaaS? Do you guys know what SaaS is? SaaS? So yeah, so SaaS is a really common term in venture capital and just the startup ecosystem right now. It stands for software as a service. So REDDY is an example of software as a service company. It's a SaaS company. All right, they're online. It's a software-based company. So what Abhi just mentioned, LTV to CAC ratio, is a SaaS metric. It's the SaaS metric of all SaaS metrics. So when you think about companies, think about what they silo into. And in this case, it's a SaaS company. So that's just a word that I wanted to put out there because it's a pretty common one that everyone should be aware of.
Can you define LTV?
Yeah, so it's the lifetime value like per actual customer. So it's basically the amount of cash flow generation that a specific customer provides your company. And then you divide that by the customer acquisition cost. So, yeah, it's basically what they provide divided by what you have to pay to get them.
So what would be an example of a customer acquisition cost? Michael?
Customer acquisition cost. So like, for example, when you need a customer, like you have to market your product, all that. So
There you
just
go.
spending money marketing, that is an expense that we have to incur. So that's how much money it takes us to get this customer onto.
There you go. Yeah, perfect. One of the most upfront costs that any startup has to use is marketing. And that's usually your customer acquisition cost. The cost to bring that customer and actually make that purchase. And the lifetime value is the average time in which that customer stays buying your product. Does anybody know any other benchmark to determine performance for a SaaS company? A metric similar to LTV over CAC. So think of a startup or a software company. What determines performance? Let's take Netflix, for example. Grace.
Just at the most basic level, I would just assume like profit.
Yeah, I mean, over time, yeah, profits is a good determinant, but specifically what drives the business would be signups. How many signups or how many people are actually purchasing subscriptions? And over time, that's how they generate their recurring revenue, as people are paying down these subscriptions. So subscription signups over the lifetime value, that's what determines it. And then you could take that customer and figure out the average time in which they stay subscribed. So there's just things to think about when you think about the business model of business. And we're going to go into later with the generalist, medtech, and SaaS metrics. Any other ways further?
No, there's more metrics on the next element.
Yeah, so like we send these slides in the newsletter, so if you guys want these metrics, you're going to have them later. But this is just a quick, exhaustive list of some metrics that a lot of companies use.
Thank you. All right, so sadly, we're all very sad. We're on our last lecture of this semester. Today we're talking about portfolio management. For those of you who haven't been here, these are the topics of all the previous lectures. And as always, thank you all for being here. So let's get into it. So what is portfolio management? Portfolio management is the art and science of selecting and overseeing a group of investments that meet long-term financial obligations and the risk tolerance of the portfolio owner. And a portfolio manager is the person who's responsible for investing a fund's assets, implementing the fund's investment strategies, and managing day-to-day portfolio management of trading assets. So always we have some key definitions for you guys. Asset management is the idea that you can increase total wealth by acquiring, maintaining, and disposing assets. Risk reward is a very important ratio in the discussion of portfolio management, which is the idea that in order to earn a reward, you have to take a risk. If you want to earn a higher reward, you have to take a higher risk. Equities and fixed incomes are kind of the meat and potatoes of portfolio management. We're going to run through some example portfolios, and you're going to see most of the vast majority of the portfolio is in equity and fixed income. And equity is basically a share of stock, and fixed incomes is another word for bonds. Standard deviation is a statistical measure. It's a measure of the degree of variance or dispersion in a set of values. And so in the context of portfolio management, we're going to be talking about returns. Portfolio is just the word to describe the amalgamation of the totality of your investments. And volatility is a financial word, just the degree of variance over time. So the first topic we're going to talk about is risk versus return, risk or risk reward. So this picture for you guys. An easy way to introduce this topic is to kind of think about career paths, right? So on the left we have Drake, and on the right we have, we'll call him a banker. Now, think about the rewards of becoming the next Drake. It'd be pretty cool to become the next Drake, right? Would it be pretty cool? Well, you have to take a lot of risks to get there. The probability that any of us could drop out of UF today and become the next Drake and live Drake's lifestyle is very low, but the reward is very high. So you're taking a very high risk if you want to do that, but you'd incur a high reward. Granted, for the banker, it's a little bit different. You're taking a lot lesser risk, you're getting a lot lesser reward, but you're much more likely, the probability that you could actually become a banker, it's a lot more probable. And so it's it depends on what we're going to learn about, which is your risk appetite. But depending on your risk appetite, this is a much safer option, and this kind of encapsulates this idea, and you can apply this to investments as well. So we got some companies here. On the left, we have what you would kind of call tech stocks, growth stocks, stocks that have high earnings potential, but they're also a little bit more risky. They're not as proven. Maybe they don't have a very important role in the economy, like a very vital role in the economy, like some of these players do. So these tech stocks are gonna, if you invest in them, you're gonna incur a lot more risk, but your reward potential is a lot higher, and that's reflected in the relative returns of both of them. This group of stocks, as opposed to this group of stocks, which is commonly referred to as blue chips, which tend to satisfy like a basic need in society, a basic need in the economy. They've been around for a while. We know what they do. We know that Walmart's not going to go bankrupt next year, like Airbnb might, for instance. Great, but the trade-off is the reward of investing in Walmart is a lot less than the potential reward of investing in Shopify.
And these equities are also a lot more volatile if you're looking at the blue chip company, or the blue chip companies are a lot less volatile. So they're going to move less, and their valuation's not going to change as much because they're proven and they don't have high areas for growth or high areas for loss, versus the companies on the left are more volatile and their worth will go up and down a lot more.
So it's a very similar concept when it applies to entrepreneurship as well in the startup world. On the left, we have Steve Jobs receiving his first check from his first venture capital buyer. And this is a guy I found on LinkedIn who's a software engineer at Google. So they both went to Stanford. Steve Jobs dropped out and started a company. He worked very hard and got hired at Google. So you can see this risk-reward idea playing out here, where Steve Jobs is incurring significantly more risk dropping out of school and starting his own company and trying to get investors than this individual is. And his payoff was, as we've observed, much higher than his will be, unless he does the same thing one day. Granted, for every Steve Jobs, there's a lot of failed Steve Jobs. And that's this idea of risk, is that not everyone is going to end up, when you take that risk, it's actually risk. Not everyone is going to end up becoming Steve Jobs. So the way that we can kind of quantify this is through returns, and this is how it's done in finance, and there's required rates of return to compensate you for these different risk levels. And these numbers are kind of arbitrary, just as the returns go up, as the risk goes up, the required return that you demand to compensate you for that risk goes up correspondingly. Yes?
Could you explain why like 5% would be risk-free? Like, wouldn't there still be some risk?
Yeah, so I have a slide. You know what? That question can be answered in 2 slides from now. Yeah, I got it. So the job of the portfolio manager is fulfilling the goal of the portfolio by matching the risk-return appetite of the owner of the portfolio, the appropriate investments that provide that yield required rates of return. So it's the idea that every single person that owns a portfolio that's hiring this portfolio manager to actually manage that portfolio, or if you manage the portfolio yourself, you're going to have different risk tolerance, and you're going to be after a different return threshold. And that's the key idea of the portfolio manager. The key job is to match the assets that you're investing in with that risk appetite. So the skills you have to be able to assess risk, you have to be able to measure risk and understand the risk of your different investments. You have to be able to manage your relationships with your constituents, the people who you're actually managing, people whose assets you're managing. You need to be able to value investments and understand the potential returns of these investments in order to make a proper investment decision. You need to have emotional control, and there's this idea of FUD, which stands for fear, uncertainty, and doubt, that can prevail in financial markets sometimes, which is kind of investing and selling out of fear, buying out of hype. Portfolio managers really want to stay away from that. A seasoned portfolio manager is not going to be buying GameStop. They're going to have a little bit more emotional maturity and be able to kind of contain those emotions. And then the most important one is strategic asset allocation, which is the idea that you're going to deploy assets, deploy capital pursuant to the risk return appetite of the owner of the portfolio. So this is going to answer Avi's question. And these kind of risk-free to high risk, stocks aren't necessarily low risk. This is all just relative to one another up here. But this is the idea of kind of pairing investments with the different return levels. So 5%, we're gonna call that risk-free because this is this is close to the going rate on most treasuries, 3-month to 10-year, they're in the high 4s, 4.5 to 5%. And this is considered risk-free because when you buy a treasury, you're loaning money to the government. The government of the United States is promising to pay you that 5% interest rate. So the idea is that this is going to be paid out unless the government defaults on its debt, which it's never done. So in the American financial system, and really this has been kind of, this idea has been exported to other countries, we view whatever the treasury rate is as the risk-free rate. And then all the other required rates of return kind of scale up from the risk-free rate. All the required rates of return on investments that aren't treasuries are spread over this risk-free rate. And here we have stocks at 7%, real estate at 10%, and then for an investment in venture capital at 14%. And here we're going to try and illustrate this idea of kind of matching up who we're investing for with different assets. So what I want you guys to do is just try and rank these in order of what you think their risk tolerance would be. Let's go with, your name is Daniel.
Grace.
Grace.
Grace, yeah.
We're gonna go with Grace. Who do you think has the highest risk appetite? Who do you think can afford to make the riskiest investments?
I'll say the gram in the middle.
Why?
Just because, well, I don't know, like, they probably have more capital considering they're more old.
Just because you have more capital, I mean, sure, I mean, that's one way to look at it. So just because you have more capital doesn't necessarily mean that you want to make riskier investments, because like, what happens if grandma has all this capital, but she makes a bunch of risky investments, she loses it all? Well, then what does grandma do? Grandma's screwed.
Yes.
Yeah. The right answer for who has the most risk tolerance is the kid, is the college student, because he has time to actually take losses. He has time to recoup those losses. He has a lot more runway. And so kind of the father is going to be in the middle. So as we get older, our risk appetite, our risk tolerance tends to diminish over time. And that's what this slide is trying to show.
What if the grandma's like on the verge of passing away?
Yeah, she has less to lose, I guess.
She has not much to lose, right? So
Would that be like, that's like a game theory thing? Yeah, if she has nothing to lose, then sure, but like, let's say grandma has 10 years left, you know, she has a lot to lose. You know, you don't want grandma losing her house.
Understood. Well, I wouldn't want anyone to lose their house.
Well, you know, that's the idea. Well, the thing is, who's worse off if they lose their house, him or her? All else the same, who's worse off if they lose their house?
Grandma, she doesn't have the.
Well, who's more capable of being okay as a result, right?
The young man.
And that's the idea that we're trying to illustrate. Cool?
She's chilling.
All right. So before we kind of get into the nitty-gritty of this topic, here's just another example. So these are totally made up numbers. This is a hedge fund. This is a pension fund for the great citizens of Minnesota, and this is BlackRock. So judging their target annual return, can we rate them in terms of who takes the most risk? Grace, who takes the most risk here? Just based off their target annual return. Who do we assume? I'm sorry?
Capital advisors, SAC.
Yes, great answer. SAC is taking the most risk because they're requiring the greatest return. So that's what's implied. If they're targeting a higher IRR or annual rate of return, what's assumed is, okay, they're going to be taking more risk to get there than, say, the Minnesota State Retirement System would. And kind of why is that? Because we can think about this intuitively too and like logically. You would expect that a pension fund would be a lot more conservative and want to take less risk with their money than a hedge fund, because the pension fund, the returns from the pension fund are going to pay people's, when they retire, when they're a public employee in Minnesota, they're living off of this money. So the portfolio managers know this, and they're designing, they're allocating their assets and allocating their capital with a knowledge of who they're doing it for. And that's why this is always going to be a lot lower. This is always going to be a lot lower than, say, a hedge fund would be. So here we go into indifference curves. So we kind of went through the grandma example, and we went through this example of these different kind of investing entities. So there's this idea of that investors are risk averse, and that's what a lot of modern portfolio management theory kind of goes off of. And you have these different indifference curves, and you can see as the standard deviation, so as standard deviation is really a proxy for risk, as there's more variance in your returns, your expected return is going to go up. So it's kind of bowed out and upward sloping, but different people are going to have different indifference curves. Meaning it takes a higher standard deviation. At the same standard deviation, the person or entity whose indifference curve is I3 requires a higher expected return here, a lower expected return here, a lower expected return here. So I1 has the lowest risk aversion, the highest risk appetite, because at the same standard deviation, their expected return is lower than I2 and I3. You kind of get how the graph works? We see that? Okay, cool. And this is kind of showing like the different shapes. If you're high risk aversion, you're going to want an expected return that goes up a lot higher as a function of standard deviation. As opposed to your low risk aversion, you're going to be a lot more okay with a lot more of that volatility. Just kind of really getting into the weeds about like kind of getting into the shoes of portfolio management. Is everyone familiar with the normal model? For the most part, probability distribution. So that's kind of what this is. And what this is showing is the distribution of the S&P 500 from 1960 to 2020. And you can see the normal model laid over. So it's not really normal per se, but it definitely mimics the way that the normal model works. On the right, we have for the IRRs from private equity, the amount of money that private equity returns to their investors. So what's important to understand is, from an asset allocation perspective, you're going to be using tables and figures like this to judge the relative risk-return payoff. And we can look at like the 5th percentile on private equity, which we know is 1.16%, as opposed to the 5th percentile on the S&P 500 annual return, which would be around negative 20%. With this S&P 500 example, well, with the private equity example, where you're thinking is, okay, I can park my money in private equity, I can sit in a fund for the fund's life for 10 years, and I'm going to return 1.12% if I'm in the bottom, 1.16% if I'm in the bottom 5th percentile. I'm in the bottom 5th percentile of my position in the S&P 500, I might lose 20% of my money, but the difference is I can actually sell this and reinvest it. Right? If I lose 20% annually, I have 9 more years on a comparative basis, as opposed to private equity companies, to actually try and make that return back. So if we were looking at this on its face, you might say, okay, with the 5th percentile private equity, the return is much higher. But what you have to think about is kind of other factors that go into the investment that are separate from the probability distribution. Yeah.
In the private equity side, do you have to keep it there for 10 years, or can you get that 1 year that's a lot better than the S&P and take your money out and do the same thing you just said? Like, why would I choose to invest in the S&P because it's safer? Like, why is it safer in this mine than that, when you just graph the returns and the returns are almost always positive on the private equity?
Typically you would. That's typically the structure of private equity. But that's also why the mean for the distribution for private equity is going to be much higher to compensate for that risk. And then you also have this potential to make a 75% IRR. And you can see that there's a lot more probability, there's a lot more potential for you to do that in a private equity investment than there is in the S&P 500. But you can look at it and you can see the standard deviation is clearly, the returns from the S&P 500 are much more centered around this mean, which looks to be around 0.12, 0.15%, than the much more spread out and volatile returns on a private equity investment. So again, standard deviation is a measure of the amount of variation in a set of values. It's helpful to look at the way that the formula works. So you're looking at the sum of the return of the investment over the average rate of return of the sum of an individual investment versus the average rate of return of a sample of like investments over the number of time periods. So this kind of goes into the idea of diversification, because we want exposure to investments with a high payoff while maintaining a certain level of security or a minimum return that's guaranteed, right? We want exposure to the potential to make 75%, as opposed to what we see when we're just in the S&P 500, where even making 0.6% is very, very unlikely. And then we get into the idea of risk-adjusted returns. This is actually a chart from one of my graduate courses, lecture from yesterday. And you're looking at unlevered and levered IRRs on an investment property. And what they're doing here is they're saying, okay, your unlevered return is 13.06%, right? No debt. Your levered return is 26.49%. But then you have these different, you have different levels of likelihood as to what return you're actually going to get. You have probabilities. And then you're going to find the standard deviation of this investment. So how volatile the standard deviation of this investment is. So the idea here is you can divide your return for the standard deviation of that investment type. And you can get a figure that is your expected return per unit of risk. What you can see here is that, this is kind of makes sense intuitively. With leverage, your expected return per unit of risk is much less without leverage, which would suggest that, okay, without taking leverage, so not only is it a less risky investment, and that's reflected through standard deviation, which is significantly less, but actually without using leverage, you're getting a lot more bang for your buck if you're looking at it from like a risk-reward ratio. Because your steady per unit of risk, you're making more return. Is that idea clear? This is late-stage venture returns from 2006 to 2016. And we can kind of see what the distribution curve looks like here as well, where the vast majority of payouts from late-stage venture funds are within the 0 to 2x range, right? So relative to the risk that I'm investing, relative to the risk of an investment in venture capital, this really isn't that great. The reason why people get into venture capital was really because of the potential for it to deliver 7x, 6, 7x, 4, 5x. So the idea is kind of, if I had $1 million portfolio, I'd be foolish to put it all into VC, right? I'd want to diversify. I'd want a little bit of exposure to the potential to make 7x. But I don't want to bet the house on I don't want to bet my entire portfolio on the idea that it's going to return 7x. And that's why we diversify. So imagine these are historicals and all else is constant. What do we think is the better investment? Right? You have one investment that's kind of see what's going on here, right? So all is constant. These are historicals for this investment. Which one do we think is better? This one has an average annual return of 5%. This one has an average annual return of 10%. What do we think? What do we think has a higher standard deviation? Yes.
Investment B.
Correct. Right, and that's bolded here. Yeah, investment B has the higher standard deviation in this example. And so, what investment is better for your portfolio? That's a matter of your risk tolerance, your risk appetite, and who you're building the portfolio for. But it's kind of, you can kind of see this graphically. It hones in on that difference, and you can kind of see the idea of volatility, where investment B is a more risky investment, albeit if investment B quote unquote hits, you're going to make a much higher annual return. Then, this is as technical as we're going to get, but there's a lot of different measures of risk that portfolio managers and people in finance use to kind of quantify risk and understand it. The most popular one is beta. Beta is a measure of risk, which another word for risk here is volatility of a portfolio against the market as a whole, and usually beta, when it's used for stocks, that market as a whole is going to be the S&P 500. So it's taking the covariance of the investment and the covariance of the market and dividing it by the variance of the market. If your beta is less than 1, then that, in this instance, that the stock is less volatile than the market. If it's greater than 1, it's more volatile than the market. It's usually applied to stocks, but it can be applied to other asset classes. For example, in real estate, hotel has the highest beta. Another measure of risk is alpha. This measures an investment's ability to beat the market, aka alpha's excess return when adjusted for risk. Alpha actually uses beta, and this is the equation for alpha. You have Jensen's alpha, which is a little bit more of an advanced version of alpha that incorporates CAPM. It's used alongside beta to assess the risk of an investment. We have the Sharpe ratio, which is very similar to that example I showed you guys from class. This compares the return of an investment with its risk. So it takes the return of the portfolio, it subtracts out the risk-free rate, which would be the rate of treasury securities, and divides it by the standard deviation of the portfolio's excess return. So it's kind of showing you on a per unit of risk basis what your return is. So all three of these methods, plus looking at standard deviation, different statistical methods such as R squared comprise modern portfolio theory, which is the idea that an investor can invest different assets that produce higher returns without necessarily having a higher risk. You can diversify, put your money in different baskets that can produce higher returns without correspondingly higher risk if you invest intelligently and you use some of these methods. So, kind of have an understanding of risk and reward. We have an understanding of how to assess risk from a technical basis. What are the different what are the different things that we can put our money into? How can we invest? What are the different categories? So this is generally speaking your different asset classes that you can pick from when you're designing a portfolio. We have equities, which are stocks, which are liquid shares of fractional ownership in public companies. Bonds, which is a type of security under which the issuer owes the holder a debt and is obliged to provide cash flow to the creditor. Private capital is an alternative investment category comprised of illiquid investments in private companies directly or through a fund. The reason why these are bolded is because from here to the right, these are considered alternative investments as opposed to from here to the left. Because the main distinguishing factor between alternative investments and traditional investment is the liquidity. Alternative investments are typically a lot less liquid than traditional investments. And there's also a difference in the expected return. You can typically make a lot more investing in alternative investments because there's a liquidity premium there. Real estate is the biggest asset class. It's an alternative investment category comprised of illiquid investments into interest in real property. Then you have commodities and collectibles. An alternative investment category comprised of investments into real assets such as crops, oil, precious metals, wine, and fine art. Yes.
Where would, say, cryptocurrencies fall in that kind of realm of asset classes?
Yeah, that's a really good question. I would put them in. I think they'd be their own. I think they'd be their own asset class, but I think they have all the characteristics that equities do. So I think they'd be their. I mean, it's kind of. I guess cryptocurrencies are a proxy for cash, or very synonymous to cash. Cash is on this left-hand side of the cash is what we consider traditional investment, right? If you look at cash as an asset, so people trade and buy cryptocurrencies like their stocks, so they would definitely be traditional. They're not alternative investments. Yeah, the biggest difference is the liquidity thing, right? An alternative investment would be like, I'm going to invest in a private equity fund, or say I'm going to buy a business, or I'm going to buy a business out. I'm going to view buying like a restaurant as an investment. That would be an alternative investment. I'm going to buy an investment property. That would be an alternative investment. It's not something that you can just go to an exchange and sell. It's not tradable. It's not marketable. So going a little deeper, the first category is equities and stocks. The kind of two ways that we make money with stocks is with dividends. So yeah, that's measuring dividend yield, which is your dividend per share divided by your price per share. It's the annual return on holding a stock relative to the purchase price, and of course growth in the stock price. Kind of different strategies associated with stocks. You have going long versus going short. So investing in a stock with the idea that your return is based on whether or not the stock price improves or whether or not the stock price goes down. You can buy options, which are contractual agreements that give you the option to buy a stock later, and you either bet that the stock is going to go up with a call, or bet that it's going to go down with a put. You have value investing versus growth investing, which we hinted at earlier. Or value investing would be investing in really the fundamentals. Another name for this would be fundamental investing. Investing in the fundamentals of the company because you think it's a good company, as opposed to growth investing, which is really investing in earnings potential, investing kind of a lot more loose with the idea that the company is going to grow very, very fast. And then you have indices and ETFs. So in the stock market, you have lots of different indexes that index different things, index the entire market as a whole, index inflation, index different industries, index different commodities, and ETFs. And just to show you guys what kind of returns you can expect, these are the S&P 500 total returns, so the compounded annual growth rate by decade. So kind of the average growth rate for each of these decades. And we can see coming off the 2010s, on average, you would make 13.33% if you just had your money in the S&P 500, which is itself an index of 500 public companies. Next is bonds. So the way that a bond works is your bond issuer, which is typically a government or company, and this is very much like a loan. You're going to invest capital into the bond, so when you buy the bond, you're giving the issuer money, and they're just paying you interest on the bond. And the amount of interest that they pay you is a coupon rate. And the bond is going to have a date in which it matures. And when it matures, you're going to get the amount that you gave them back. So governments issue this to raise debt, to do all the things that governments do. Companies issue this as a form of financing. When you learn about corporate financing, you'll learn about the trade-offs of issuing bonds versus giving out different traditional loans versus raising equity. And the way that we kind of understand the risk associated with bonds is the rating scale. So most bonds that you can buy publicly, that you can buy easily, are rated by the 3 ratings agencies. There's a point where you're no longer investment grade when you're below BBB. 3 ratings agencies are S&P, Moody's, and Fitch. So at the top, always AAA rated. You have risk-free securities. Well, they actually just got downgraded. But typically speaking, U.S. Treasuries are risk-free and they're AAA. At the bottom, you have junk bonds, which are an example of a junk bond would be, I'm trying to start a business out of my garage and I want to issue bonds, and obviously I'm not going to be rated very high, and so the return on junk bonds is going to be much higher to compensate investors for that risk, right? So the return level for risk-free securities for your AAA stuff is going to be a lot lower than your return level for the lower rated bonds. So from an investment perspective, that'd be your return, the amount that you'd be getting. Looking at private capital, we've covered a lot of these extensively in the course so far at Warrington Ventures. Venture capital, buyout, private equity, search funds, debt funds, hedge funds. So we're not going to go into detail about what each of these are, but you have this idea of like direct investing versus fund investing. So when you're looking at trying to deploy private capital, and I brought up that example of buying a restaurant directly, like what are the pros and cons of just buying a restaurant with my capital if I want to build a portfolio versus investing in a private equity company that is trying to roll up a portfolio of restaurants? Well, the pros of investing in the private equity company instead is I get diversification across the fund. The fund is professionally managed by specialists, so there's people with, say, if this is a private equity company that focuses in the food industry, they might have been in the industry in a while. Many of the employees probably were industry professionals in the restaurant space before they joined private equity. And it takes a lot less time and effort. I don't have to deal with owning a restaurant and hiring staff and hiring a manager to perhaps do that, but even that can be a headache. So it's generally a lot easier. What are the cons? Well, there's loss of control over the invested dollars, right? I'm not in control of the way that my invested money is being spent. Also, if I invest in funds, I can't take it out as we've discussed. Typically, I won't be able to pull my money out of the fund. There's going to be management fees due regardless of performance. So funds, in order to keep the lights on, will charge management fees, which I will have to pay if the fund performs or if the fund goes to zero. And I have potentially lower returns. If I buy a restaurant myself and the restaurant takes off, my return threshold is going to be much higher than if I invested in a fund that rolled up a bunch of different restaurants. And so the idea of diversification here is that, continuing with that restaurant example, if I invest money into a private equity company that's going to be rolling up a bunch of restaurants, I'm no longer exposed to one restaurant. I'm exposed to a portfolio of restaurants that the private equity company is rolling up. And so you have lower risk. Next category is real estate, the world's most popular asset class. Really the important thing to take away from a fund management perspective is you have different 4 general categories of real estate, scaling up from core all the way to opportunistic. With core kind of being performing properties in high quality locations that you don't really have to do anything to. And because you don't really have to do anything to them, you buy them and they give you cash flow just like a bond would. Just like if a bond issuer was giving you coupon payments, that's the idea of a core asset. Core plus is really core, but there's a little bit more risk involved. So when you buy a core plus asset, you'd want a higher return threshold. Value add is kind of getting it's being a little bit more entrepreneurial, where you see a real estate investment and you think that you could buy it and you could put in some capital and you can reposition the property and then it can start cash flowing and you can sell it for more than you bought it for. This is a lot like the LBO model that private equity companies use. And opportunistic is just buying an empty lot or buying a lot with a building on it, destroying it, and then building a new building from the ground up. But the cool thing is, every building you see started off as an opportunistic investment. So every building that you kind of interact with on a day-to-day basis across asset classes was kind of conceptualized at some level by some fund manager, portfolio manager, as, yeah, we're going to take a shot here at this opportunistic opportunity. Yeah.
Where would someone that, say, flips houses for a job fall into this right here?
That'd be value add. If you want to buy a house, you're going to put 30 grand into it, get a new swimming pool, like new walls, new appliances. Bread and butter value add. Yeah. Yeah, these are the annualized returns for real estate. And this is from a real estate private equity company. And I decided to include this because this kind of, the way that they're trying to communicate this to investors is really what we're talking about today when we talk about risk return. What they're saying is that your risk is, your return is virtually, it's very similar. Your return is very much the same. But the risk of investing in a public REIT, which just think of that as a stock, and then normal stock. Your risk for investing in stocks is much higher than giving your money to them investing in real estate. So they're trying to tell you, no, invest with us. But using the same logic that we've talked about today. Now we're going to go to commodities and collectibles. And I think this one's pretty fun because it's not really talked about that much. We have a couple examples to show you. This first one is investing in fine art. So this is a startup that you can actually take real positions in fine art. So these are all art pieces that their investors are buying into. And they're saying, look, if you buy into Banksy, or you buy Banksy, for example, they're like an art brokerage. After 378 days, your annualized return is 32% on the year. You buy into the right art pieces, after 442 days, you're annualizing 40% returns, which is pretty cool. But this, this is something to be taken seriously too, because you see a lot of very wealthy people actually when they have a lot of investable capital and they don't really know what to do with it. That's why you see them really buying all these big art collections, because it's commonly viewed as a place to kind of park money, and then the value of the art will appreciate over time. And I thought this was really interesting too, because when I was doing the research for the presentation, you see a bank institute named fine wine as a commodity and as part of a category of alternative investments. This is another startup called VIN, and they allow you to invest capital into fine wine. I thought this was pretty cool. They have 84 offerings of fine wine. They return $350,000 off of $10,000 of wine bottles. And there's 11,000 people doing this, so it's pretty interesting. And this is precious metals. So this is the historic gold price. And you can see gold has definitely exploded over the years. A little bit of trivia, not really trivia, this is pretty important. Does anyone know why the gold price was stable before 1971? Yeah.
Because of the gold standard.
Exactly. Yeah. So before we went off the gold standard in 1971, you could actually go to a bank and exchange dollars for gold. Every dollar was backed by a certain amount of gold. So they tried to keep the price of gold very stable, because the price of gold would be its purchasing power. So purchasing power would pretty relative would stay the same. You'd want to exchange your dollar for the same amount of gold every time. But ever since we got off the gold standard, you see that kind of as a function of the deflation of the U.S. dollar, the price per ounce has gone way up. And that's why gold is typically used as a hedge against inflation. And then you see the silver price, which is just another price of another commodity that one could invest into. Now quickly, we're almost finished. We have the portfolio design process. So this is actually it was interesting. All the portfolio managers' websites that I visited to, they really like to use this wheel idea. But we can go through this and you'll see the idea is very, very similar. Understand the needs and expectations of the client. Develop your strategy. So it's a strategic asset allocation committee. So they're going to, given the needs, they're going to decide how to allocate assets. They're going to have a stock selection committee, fixed income committee, collectives committee. So it looks like this portfolio manager might be investing in art. And then they're going to execute that strategy, and the investment manager is going to make those acquisitions and manage those assets. Here we see the investment process of this company. So they're going to start with risk-based strategic asset allocation, using forward-looking capital markets assumptions. They're going to implement their strategy. The manager is going to design the portfolio, and they're going to conduct due diligence. Lastly, we have some example portfolios. This is TIAA. It's a financial services company. They are a financial advisor. And you can see their asset allocation. So they have 40.64% of their capital in fixed incomes, which are bonds, 30% in equities, about 14% in real estate. Another category of real assets, so real tangible goods, so commodities other than real estate. I'd be interested to know what those real assets are. 8% in private capital, so 8% either, the most likely case is 8% in private equity funds, venture capital funds, etc., and then 10% in multi-asset. This is a New York State Common Retirement Fund. They have a great looking logo. Their asset allocation is a lot more diversified. About 35% domestic equity, 20% bonds, 15% international equities. So about 50% of this portfolio is equities, is stocks, 14% private equity, 8% real estate, 1.4% short-term investments, 2% real assets, and 3% in credit. So this pension fund is actually originating loans. Here's what these mortgage loans and this credit would suggest. And your bonus. This is a Boeing. So oftentimes big private companies will have pension systems as well. This is Boeing's pension system. Most of it's in bonds, global equities, private equity, real estate, real assets, and hedge funds. And that's all I got. Thank you guys.